Look at how effective risk management can provide both resilience to withstand adverse events and the ability to take advantage of developmental opportunities. We also take a closer look at the CASA draft call termination regulations and how this will affect operators in the South African context with Dr. Christoph Stork. And Christoph is a senior researcher at Research ICT Africa. And we also find out why creative industries in the developing world have been showing faster growth, with Caroline Quintana of UNCTAD and Bernard Bayeke of the EAC. And they are joining us from our studios in Cape Town. Now, according to the World Development Report 2014, which is titled Risk and Opportunity, Managing Risk for Development, adverse shocks, above all health, weather shocks and economic crises, play a major role in pushing households below the poverty line and keeping them there. The report concludes that managing risks responsibly and effectively can save lives, avert economic damages, prevent developmental setbacks, and even unleash opportunities. Joining us from Washington in the US is Norman LOAYZA, World Bank Director and lead author. Norman, thank you so much for joining us. Why is risk management an important part of a country's developmental plan?
Thank you. The report concludes that risk management, when it is conducted effectively and responsibly, can be a powerful tool for development. It can save lives, it can prevent crises, and it can open opportunities, especially for the poor. When the poor feel more secure and protected, they are more willing to take new ventures that will eventually lead them to development and progress.
Do governments perceive risk management as a grudge cost? And if they do, where does this leave risk management in the broader policy conversation?
Well, we argue in the report very strongly that governments and institutions should take into account uncertainty and risk when they make their planning. The truth is that the world is constantly changing, and if we want to make plans that will make sense and will be effective to deal with whatever occurs, then we need to take into account that shocks might occur, that financial crisis might happen in the rest of the world, and that necessary steps should be taken to address those changes. And we see that lots of countries, especially developing countries, emerging market economies, are taking steps to prepare their economies to withstand those shocks. We think that is a sign of progress.
Looking at those developing countries and emerging economies that you speak of, Norman, how does Africa as a continent fare? Are we any closer to having good risk management policies in place?
Many countries in sub-Saharan Africa have made taken important steps towards good risk management. Let me give you two examples. Kenya is an example that we cite in the report as an example of good macroeconomic management. The country suffered quite a lot from the crisis in the 1990s, but in the recent crisis, the 2008-2009, the country was able to recover fast. And this was thanks to its strong macroeconomic stance and the macroprudential policies that it had undertaken for the financial system. Let me give you another example, and this is Ethiopia. Ethiopia is a country that has suffered from droughts for many years, causing food insecurity. In the 2000 drought in Ethiopia led to a large loss in assets, particularly for the 40% of the population that were the poorest. There is an estimate that says that the 40% poorest in population lost between 60 and 80% of their assets. Now, Ethiopia took this issue very seriously and created a safety net program, which is called the Productive Safety Net Program in 2005, that is now protecting about 7 million people from food insecurity. This is quite a step towards risk management, especially to protect the vulnerable.
Practically speaking, Norman, how should governments seek to transition from being reactory when it comes to risk management towards being more proactive?
We are advocating the report that every country should have a national risk board. That is a group of people associated with the government that will assess the risks that the country faces as a nation, as a whole, and that will prioritize those risks and assign resources to deal with them. And that they should use especially the resources that are accumulated in good times to withstand the shocks, the adverse events that come in bad times. So it is using good times to prepare for bad times that is the key.
Let's talk about some of the opportunities that you allude to that risk management can afford a country. Where are these opportunities?
The opportunities come from the new technologies that are being developed, from the openness to international trade and international finance, and from migration, just to give you a few examples. So, for instance, in the report we say that farmers in Ghana and in India are changing their cropping patterns to adopt new technologies, and they are doing so because they have access to rainfall insurance. In other countries that don't have this access to this type of insurance, farmers are very risk averse. They prefer to stick to their traditional cropping patterns and cultivation techniques because they are afraid of the losses that might occur. So when you give these risk management tools to people, whether they are farmers, bankers, or country managers, they actually take better risks, more informed risks that will eventually yield benefits for development.
Lastly, before I let you go, Norman, if we look at risks from natural disasters, are there investment opportunities for players who perhaps want to contribute by putting up regional and continental risk management systems in that regard?
Yes, especially for countries that are very interconnected, for countries, and I can see that there are many in sub-Saharan Africa, regional agreements are the way to handle this type of risks. In fact, we pay a lot of importance in the report to risk sharing, to sharing risks across countries and across regions, and that is the way to minimize the losses that might occur to any particular one and improve the benefits that might occur.
Norman, thank you so much for joining us on the line. Of course, that was Norman LOAYZA, World Bank Director and lead author there.